If you are like me, a fair amount of your time was once spent worrying about your GPA and SAT score. Just like those figures were used to determine what college you got into, your credit score determines your ability to borrow money. Every credit card, loan, and payment is recorded, and the sum of your financial history is tabulated into a number on a scale between 300 and 800. That's called your credit score. If you have ever had the commercial jingle stuck in your head, you probably have some idea of what a credit score is. But behind the marketing humor is a number that can cost you, and young people need to be extra careful. The two biggest pieces that determine your credit score are your payment history and outstanding debt. Most young people have very little to no credit history, which limits how much they can borrow at a good interest rate. The best way to improve your score is not to fear credit, but to use it responsibly. For first-time applicants, some banks extend student credit cards or courtesy cards to checking customers with a low limit to help you get started. It's a good idea, but don't miss a bill. Keep the balance below 30% of your available credit and limit yourself to one card. Young people often have a lot of outstanding debt in the form of a student loan. Follow the same rules. Don't miss a payment and pay them off quickly to raise your score. 700 is considered a good score. The national average for those 18 to 24 is 638, and it only rises to 652 for those 24 to 34. Challenge yourself to beat the trend. Every 12 months, you are entitled to a free credit report. Check it for errors. A higher score could save you thousands in interest payments, so make sure you are being evaluated fairly. If qualifying for loans is not enough to motivate you, know that more and more insurers, landlords, cell carriers, and even employers are checking credit scores to determine your level of personal responsibility. To learn and share strategies for raising your credit score,